Good afternoon, everybody, and welcome to this webinar. We are very happy that Dana Willmer is joining us today. He's going to tell his story about the cloud, the impact on business valuations. Dana, good morning for you.
Good morning, good afternoon for you guys.
Yes. I want to take you the floor. If you have any questions, you can add them in the IM. Me and my colleague Anne are happy to answer them, and also ask Dana during the presentations the questions that are popping up. As well, you can ask your questions later on. We will record this session and we will share it, of course, with you afterwards.
Okay, great. Thank you and welcome everyone. Happy to be here. What I'm going to do is share with you a survey, the results of a survey I did last year that offers some insights into the impact the cloud is having on business valuations, along with insights I've gained from work I've done with individual partners. Now, for those of you who may not be familiar with me, I have been active in the Microsoft ecosystem for roughly the last 10 years, a good part of that actually starting in the Dynamics ecosystem with SalesWorks and George Brown. Many of you may be familiar with that organization. Did a few things there, particularly around cloud transition. It's pretty much been my exclusive focus for the last 7 years. I have done a lot of work in terms of benchmarking partners, gathering financial and operational data, and kind of, understanding best-in-class performance, how you get to that, as well as done a lot of project work for Microsoft. Was with George, the co-author of the first cloud profitability guides that were in the Dynamics ecosystem, going back now 5 or 6 years ago. I'm sorry, I'm not. Just got a name. Yeah. Okay, I'm gonna ignore the messages for a moment and just do the presentation. If anybody has questions, just shout out at any point. Worked with partners really on 4 continents now, but a lot of the partners that I've worked with most of the partners actually have been in Europe and North America, and it's pretty even split actually. Although I live in North America, a lot of the work that I do and have done has been with European partners, and a lot of work in the Dynamics ecosystem. You see some of the other things that I've done there in terms of cloud-related work over the last 8 years, but fundamentally it all boils down to 3 things: helping partners accelerate the rate of cloud adoption, because it's been for quite a while now my firm belief that that is key to really their future prosperity, if not, frankly, in some cases, survival. Secondly, help them reduce the risk that's associated with any fundamental business model transition as moving to the cloud or adopting a cloud focus is. We should have no illusions about that. It is a different business model. And most importantly, really help them make sure that the business that they end up with as a result of having adopted more of a cloud focus is worth more than the business that they started out with. Because as an owner, if that's not what's happening, well, you have to wonder what the whole point is. Now, I mentioned that I'm going to, share with you the results of a study I did last year. I do them every year, or have done for the last 2 years. I'm going to be doing another one in about a month's time now around how well partners are capitalized, how sufficient their funding is for cloud transition. But last year's study was really focused on a couple of things. And by the way, if you would like a copy of the study, you can just go to my website. The URL will be at the end of the presentation. You can download it there. But fundamentally, the focus of 2017's study was on 4 areas. First of all, how has revenue shifted? How does the P&L look different now than it did in the past, say before the cloud? How fast are different revenue streams growing? What's happening to margins for those individual revenue streams? And overall, what are partners doing in the way of growth strategies? How are they looking to drive their business forward, and how are they looking to grow it with respect to the cloud, but more generally as well? And there were a number of partners that that participated in the study. I have done a lot of work with the Dynamics ecosystem, as I mentioned, but also with a number of other partner types, really quite a cross-section of the partner ecosystem. About a quarter to a third of the partners participating in last year's surveys were either Dynamics VARs or Dynamics ISVs, but there were also a significant proportion of systems integrators in that mix and managed services providers. So really a broad cross-section of the partner ecosystem, if you will, participated in the 2017 study. In terms of the actual size of partners that were participating, as you can see, most of them were under 10 million in revenue. In fact, probably a little bit over a quarter had less than 5 million in annual turnover, well, 30% had revenues between 5 and 10 million. So, well over half the partners that were contributing to the survey had revenue under 10 million, and then there were a few that were, substantially bigger than that. In a lot of cases, these were ISVs, in some cases, systems integrators, but really a pretty broad section of different, partner sizes as well as partner types. So a real kind of cross-section look at what was happening in the ecosystem. This is how partners' revenue really sort of broke down. Just to give you a flavor of the different business models that were, that were in play. Of course, because of the heavy concentration, first of all, of systems integrators, but also Dynamics VARs, a lot, if you look at the group combined, its overall revenue still has a lot of professional services in the mix. There's a lot of still reselling of traditional third-party software, sort of the green bar and the green slice and the red slice there. That's pretty much obviously representative of the Dynamics ecosystem, because there were a lot of Dynamics partners as well. There was a significant component of maintenance in the revenue mix, but there were also managed services providers taking part, as I mentioned, in the survey. So there was a significant portion also of managed services or contracted report, and then other kind of more cloud-related or hosting or hardware-related revenue streams sort of comprise the mix. But just to give you a picture of where partners were deriving their revenue, in total, there were roughly 20 partners that participated, and the total kind of combined revenue was just under $500 million in combined revenue. Now, I want to call out particularly, because this is kind of the, getting to the meat of the matter, there were a couple of really key findings. And the first was with respect to how fast revenue is growing, how fast different revenue streams are growing, and what the margins are that different revenue streams are throwing off. And I want to kind of call out, the first two bars that are own IP licenses, whether sold in the form of cloud subscriptions or as traditional sort of perpetual one-time licenses. As you can see, from a margin profile perspective, those two revenue streams were the highest performing sources of revenue in the mix, and often yielded, on average, margins to partners in excess of 60%. In some cases, far higher. If you had been in the business of monetizing your IP for a period of time, as a lot of ISVs, of course, are, then their margin profile is often, 70% or more. The particular other interesting thing is that the rate of growth in cloud subscriptions for own IP was also very, very substantial. It was the second highest growing revenue stream, next to the base sort of cloud subscription revenue that you see pointed out in the green arrow at the bottom there. So, fundamentally, in terms of where revenue growth is, it's probably no surprise to learn that the highest growing revenue streams are either cloud subscriptions that are, say, base, either Office 365, Dynamics 365, that kind of thing. They're the fastest growing. And own IP is also fast growing, but it's also driving significantly higher margins than are available from other activities that a partner could engage in. And if you sort of look at the amber bar there, or orange bars, you'll see that, again, IP is the fastest yield, rather the highest performing, revenue stream from a margin perspective, followed by, hosting. There were a number of hosters in the mix, managed services, and the traditional kind of professional services based business is, on average running around 40% in gross margins. Now, I know from work I've done with European partners that a lot of times it's less than that. And the other thing that's happening, of course, is that there is less of an appetite for professional services generally at the customer side, so it's not growing as fast as other revenue streams are. You can see that very clearly in the graph as well. And the margin that's available from professional services is also under pressure. Now, it's under pressure to varying degrees in different markets for sure, but nonetheless under pressure, far more so than is the case with other revenue streams, and particularly own IP in that context. Just give you a flavor of how fast different revenue streams are growing and how they're performing from a margin perspective at the partner level. Now I want to kind of call up, because we're going to talk in a moment about valuations, but I want to kind of frame why that's important. It's been my experience that really, the key thing to a partner, making their business worth more, increasing their business valuation, particularly in the day and age of the cloud, is to not focus so much on short-term P&L impacts, but to focus on what's happening to the fundamental valuation of the business, because the thing of it is that in the short term, the P&L probably often really moves in an opposite direction to what's happening to the valuation of the business if you're doing the right things. And if you focus too much on what's happening to the short-term profitability of your business, you're probably missing the opportunity to increase its valuation. I'm not saying for a moment that you shouldn't be concerned about profitability. Of course you should. Every owner should. But more fundamentally, it's going to require, in order to build the value of your business, a focus more on that than on what's happening to the short-term profitability of your business. And here's really why. I've called this the P&L trap because I've seen a lot of partners, actually get held up or get stuck in a focus in the short term on short-term P&L impacts, and they really miss the opportunity to build a higher valuation of the business. The fundamental thing about the cloud, of course, and this has been known for quite a while, is that in the short term it most likely has a negative P&L impact. Now, that P&L impact and it can last for different periods of time, and it can be of different magnitudes. But fundamentally, in the short term, in order to transition a business model to the cloud, you're really, as an owner, forced to do two things. You're forced to make investments in some form of new offering development, and hopefully that it contains elements of your own IP for reasons that I just discussed. It's fastest growing, but it's also the highest margin activity you can engage in. The reality is that in the cloud, the customer doesn't want to buy the same old thing as they did in the traditional business model. They want to buy more packaged, more productized solutions, things that deliver, greater business value, greater business impact pretty much out of the box. And so you can't sell the same old wine in a brand new bottle and hope to be successful in the cloud. There's a need to produce or to generate or to build, a new offering to some degree that a customer will want to buy. Again, a productized or packaged solution. So there's investments that are required in order to develop that offer to be successful in the cloud. That's the first source of investment. And the second source of investment that's needed, of course, is to acquire customers for that offering. And, in the cloud, obviously, the revenue that comes in is in subscription form, and it's over time. So in the short term, the cost of acquiring a customer is well in excess of the revenue and the margin that customer throws off. Now, this is very different from the traditional business model, of course, where you got lump sums of cash up front for licenses and margin, or for licenses and for services. And so there wasn't the same kind of cash flow impact. There very much is as you move towards transitioning to the cloud. There's a period of what I call a cash flow trough that has been well established, and there are ways to sort of make that cash flow trough shorter and less deep, but it's going to be there in some form. And the fact is that it requires that investment in order to build the business valuations that are higher and that are more cloud focused. Well, let's talk a little bit about what actually drives the valuation of a business. And in my experience, it really does boil down to four key things. This is, really what what investors looking into the business, either to buy it or from the perspective of providing perhaps capital to more aggressively transition your business to the cloud, they really look at four things in terms of determining how, what a business is worth. The first is revenue composition. What kinds of revenue do you have on your P&L, and how durable is it? In other words, how long is it going to last? And this sort of obviously gets to the point of whether that revenue stream is one-time or recurring. Project services, of course, one time. Maintenance, of course, recurring. So the more that your P&L has recurring revenue streams to it, the more valuable it will be, the more valuable the business will be overall. Another key thing that determines the value of the business is how fast that revenue is growing. Now, we all know that the rate of growth, and we've just seen in a few slides ago that cloud-related revenue streams and cloud, growth and demand for cloud solutions generally is growing far faster than the rate of growth for more traditional solutions. The rate of growth for cloud solutions is 20, 30, 40% per year in terms of growth rates. Often it depends on the markets, but it's very substantial, whereas the growth typically for more traditional solutions is far less than that, often in single digits. So how fast your revenue is growing overall also makes a big difference in terms of what the valuation of the business is. And the final thing that's really important in terms of determining valuation is what the margin structure is like, because not all revenue streams are equal, as again we saw from the previous graph. You get far less in margin from the simple act of reselling, whether it's a traditional sort of perpetual license or whether it's a cloud subscription. The margin you get on that is far less than the margin that you get from your own services, hopefully, and at least on average in most cases, and that in turn is far less than the margins you can get from, for example, your own IP. So looking at it overall, your business is valued according to what kind of revenue streams you have on your P&L, how long that revenue can be predictably counted on to last, whether it's recurring or not, how fast it's growing, and what your overall margin levels are in the business. And that again gets back to what kinds of revenue streams you have on your P&L. I'm going to go into more detail just in terms of the actual findings of valuation ranges in a moment. But before I do that, I want to just sort of, give you a caveat really, because, here's the thing. A privately held business is not liquid, right? It's not like a publicly traded share. You can't sell it. There's no market for it. So really, a privately held business is fundamentally only worth what someone's willing to pay for it, who can pay for it. In other words, as the saying goes, beauty is in the eye of the beholder. Well, the valuation of a business is in the eye of a potential purchaser, who actually has the means to pay for it. And this means very often that the same business can be worth very different things to different people. It depends fundamentally on what their appetite is to make a particular investment, and also what they plan to do with the business once they acquire it. So I'm going to give you some ranges that have been validated by the research that I've done, but bear in mind that may not necessarily be the exact valuation of your business, because it literally can depend upon who the potential purchaser is. So here's what tumbled out of the research in terms of the different valuation ranges. There's quite a range you can see. The average the average valuation multiple for, let's call it, traditional businesses, and in the survey sample overall, was around 1x revenue. Now, I would say that these days, while there are still a lot of investors valuing business based on its profitability or EBITDA, overall the shift is more towards looking at a valuation multiple as a function of revenue. Why? Because in the short term, as I just explained, if the business is transitioning to the cloud, it is it is likely aggressively investing in developing cloud-specific offers and in acquiring customers, and those will depress in the short term the P&L, and so you can't really base the value of a business on what's happening in a short-term profitability sense. It's more a function of what it's likely to become, and that valuation multiple tends to get back more and more, at least, to being a function of revenue. So, basically in the work that I do and the sample that I surveyed, and as I say, other work that I do for partners generally, you'll see valuation multiples anywhere from less than half of revenue to over 4 times revenue. And what makes the difference? Well, again, it's the composition of the revenue, how long they can be predicted to last, how fast they're growing, and how big the margins are, or how strong the margins are. I would say that on average, the traditional business now is probably valued, as we'll see, somewhere between 0.5 and 1 times revenue. That's the range. If you look at businesses that are growing fast and that have high concentrations of their own IP in them, they are being valued at 4 to 5 times revenue, sometimes even higher. This is within the Dynamics ecosystem, by the way. I know some of you will have seen numbers that are far higher than that, and that's true for some companies, but typically not for businesses within the Dynamics ecosystem. You really do see that kind of range, and it's still a very significant range. I mean, obviously, 0.5 times revenue to say 4 or 5 times revenue. That's a 10 times difference, and so it really does matter from the point of view of valuation. How fast your business basically is transitioning to cloud-based revenue streams, to revenue streams that are more recurring and that have higher margins associated with them. Let me give you a few more specific examples. I'll explain in a moment the different sort of methods that are used there, cash flow versus market method. But let's take an example of a traditional business model. This again may not be representative of your individual business. By the way, if I have developed a proprietary model, calibrated it with a number of partners, and it is based on actual market transactions, or actual market transactions, either partners having sold their businesses or other investors having put money into businesses to help them grow. So the model is calibrated. But let's just say that you have a business that today has about $6 million in revenue, most of it in the form of professional services. This would probably be say a young Dynamics practice, a little bit of third-party software reselling. That business today is probably going to be in the 0.5 times revenue range. Now, I'll explain just a little bit the different calculations there. There's two estimates down there. The market method, if you will, is based on actual research that I did and statistical analysis that I did with a venture capitalist a couple of years ago, and we basically, as I say, did a statistical analysis that looked at a couple hundred transactions that he had access to as a venture capitalist, and we sort of derived a formula based on that analysis. So if you use that formula, you come out with, in these with this kind of a business model picture, about 0.4 times revenue. The cash flow method really just looks at what revenue streams you have and what margins they're throwing off and how far into the future rather they can be predicted to last. That's a calculation that I've evolved again in work with partners. But you can see that either way, you're looking at a business valuation for the more traditional model that is probably in the 0.5 times revenue range. If you shift that revenue composition over time, as an example, to contain more cloud subscription revenue, which is recurring, not necessarily higher margin, in fact, certainly not higher margin, but if that revenue profile or if that revenue mix contains more of your own IP licenses and perhaps some managed services, you move towards a P&L, which is far more based on recurring revenue and higher margin recurring revenue. And that practically speaking, more than doubles the value of the business. Now, how much of a lift in valuation, any individual business might experience, depends upon where it is today in terms of its revenue composition, growth rates, margin structure, revenue durability, as I explained a moment ago, and where it can realistically end up in a couple of years' time. Those two things obviously are going to be specific to any individual business, and a lot of the work that I do, frankly, is to help partners map out what their strategy is to create shareholder value over time. But this hopefully just gives you a sense of what some of the ranges are and what some of the key levers are in terms of driving out higher business valuations over time. All of this, at least in the work that I do now, kind of, leaves owners with a particular question on their mind, which is, what do I do in the face of this? What are my options in terms of the business overall? And because there's no question, I don't think any longer, that the cloud is here to stay. That it's a different business model. B, so it's kind of it's not a fad. It's not going anywhere. Whether we like it or not, whether we like the effects that it's having on our businesses and our business valuations, whether we like that or not, we have to deal with it. And the question on most owners' minds is, okay, how do I deal with it? What specifically do I do? And there are a number of options, but to me, it kind of boils down to really two. And the first, quite frankly, is if you don't think that you want to go through the effort and make the investment to transition the business, now's probably the time to think of selling. And I say that because obviously transitioning the business to the cloud and building a higher business valuation doesn't happen overnight. I mean, it takes time for the investments that you make to have an effect. It takes time to build revenue. It takes time to develop offerings. It takes time to acquire customers. All of those things you need to do in order to build a business that's worth more. And if you just don't have the inclination for that, then now is probably a good time to be looking at exiting the business, quite frankly, as an owner. And I would also say this, I spent the first decade of a little bit more than a decade of my career in the investment business, was a stockbroker and investment analyst. And, I learned for sure that from that experience, I don't have a crystal ball. I can't predict, what the future holds or what the markets are going to do. But I have observed certain patterns over the years that I've been around and in business, and particularly over the time I spent in the investment business. And what I know from that is that investors love a sexy story, and Satya has made Microsoft sexy again. And so if you're looking, or if you're thinking of exiting the business, if that's the option that makes sense for you, then my counsel, my advice would be to seriously consider, if that's what you want to do, doing it now. Because my belief, and again, I can't predict the future. I have been wrong in the past. Any person in the investment business knows that happens. But my sense strongly is that this timing is about as good as any, because here's the thing. As I say, investors love sexy stories, and Satya has made Microsoft sexy again as a story. There is a lot of investor interest in the Microsoft ecosystem. I see that very clearly, in the work that I do with partners and in the transactions that I have helped partners put together. But it doesn't last forever. Eventually, an investment community, investors, just find something else to be sexier, quite frankly, and they move on to whatever that is. So, as the saying goes, you want to strike while the iron is hot. And, my experience and my instincts tell me that in terms of exiting the business, this is about as good a time as, you're likely to see. Again, if that's the option that makes sense for you, if you don't feel inclined towards the investments and the effort involved in transitioning towards the cloud. If you do, however, want to continue in the business and build a business that is worth more in the future, and that is viable and strong and healthy and has a high valuation in this cloud first world we now live in. The answer really, or the strongest thing you can do, is look towards developing and monetizing some form of intellectual property. I think that the economics of it I explained a moment ago. It's the highest margin activity you can engage in. It's also the fastest growing revenue stream, because that's basically where customer demand is, right? In the cloud, they want to buy solutions that deliver instant business value, or fairly instant business value, right out of the box. They want to buy packaged or productized solutions, and that means that they contain intellectual property. That means that you have, that you have developed something that customers can easily consume and get immediate business value from. And this kind of begs the question of, well, how do I as a partner go about developing that intellectual property? I mean, what do I do in practice that allows me to do that? And I know in a lot of conversations I have with partners, one of the first reactions I get when I say that the future lies from a valuation perspective as a partner in the development of your own IP, the reaction I often get is, but that's not something I've ever done. You don't understand. That's not my business. And I know that it certainly for many of you hasn't been your business in the past. But what I also know is that there is a progression to it that takes place over time, and there are things that you can do that accelerate and that lessen the cost of developing your own IP. Having worked with a number of ISVs in the Microsoft ecosystem, both inside the Dynamics side of the Microsoft world as well as outside, most ISVs, if you think about it, didn't become ISV. They didn't start out with the intention of becoming an ISV. It's something they evolved to over time. The question really becomes, how fast can you make that happen, and how cost effectively can you make that happen? And in that regard, in all the work that I've done, it kind of comes down to a couple of key things. It starts with choosing a focus, because you can't build a product without a focus, right? I mean, the traditional business model, pretty much the value proposition to the customer was, we'll build a solution that's unique to you, that's designed specifically for you. Well, turns out that's not so much what customers want to buy anymore. They don't want to be unique, because their experience is that often gets expensive, and if they're, to the degree they're unique today, they probably won't be unique tomorrow, because whatever it is they bought to be unique from a technology perspective, everybody else will have at some future point. We as a technology industry, exist to diffuse technology, to make sure that we sell as much of it to as many people as we can. So over time, my strong feeling is, also having having spent the first part of my career outside of the technology game, is that getting strategic advantage out of technology often is expensive and very often doesn't last very long. And I think that's really part of the customer demand for more packaged solutions. Really, what they're looking for is competitive parity, if you will. They can't be behind their competition. They have to be at least as good as their competition. But very often, their real differentiation does not come from technology. Certainly not technology that's available to everyone. So really, in terms of developing IP, you first of all have to define a focus for what it is that IP will contain, what it is that it'll do. And there's a couple of key ways that I found, partners who are successfully developing and have successfully monetized their own IP, traditional partners who have moved in that direction. There's a couple of things that on average, that overall I've seen them do. They first of all start by, looking at who their customers are, and looking for leverage, right? I mean, every Dynamics partner I've ever worked with, has some kind of some kind of specialization in their customer base, even if they never intended it, right? Just over time, you will have accumulated a customer base with a certain set of characteristics, and one of the key things is to identify where your concentration of expertise and know-how lies, and also what you can leverage often in terms of any past project work and ideally any repeatable code. So it really does start with often looking at who your customers are, what you sold them, where the logical groupings, where your expertise and your previous project experience and hopefully reusable code lies. So choose a focus first of all by looking at your customer base. But that's really not enough. The other thing that I very strongly find is that in the cloud, customers don't buy technology. They buy business outcomes. That's not a new idea. It's not my idea. It was J.B. Wood in his books, Consumption Economics, and a couple of others that sort of laid that out. But customers buy business outcomes. They buy business results. The saying is nobody buys a drill. They buy the hole that they can make with that drill. And so, you need to, having defined a focus in terms of your own intellectual property, be very clear on what business problem you're solving and what that results in the way of business outcomes. And those business outcomes, in my experience, can be of two kinds. The most obvious probably is industry-specific or vertically specific business outcomes. And there's no question that that focus is probably the strongest in terms of market appeal and in terms of potential financial opportunity. But I also find partners very successfully monetizing what I would call functional business outcomes. So think of a business as having different functions. I mean, an HR solution, for example, would be an instance of solving a functional business problems. They're business outcomes that you can produce, they're business impacts you can have that aren't specific to an industry, but that nonetheless, can be quantified and are real, and you can demonstrate that they're of value to the customer. And really, as a final point in terms of solving a business problem, I increasingly find that it boils down to, three levers in terms of business problems. The first is, can I reduce risk for a customer? Can I reduce cost for a customer? Or can I increase revenue for a customer? Really, those three things. And they're pretty much in that order of importance. The first thing that is that customers are customers are going to be most attracted to reducing risk in their business. It's just human nature. We fear losing something more than we're motivated to gain something. So if you can, if you can key on IP that reduces risk in a customer business, that'll be the strongest positioning that you can have in a lot of cases. And in fact, outside of the Dynamics ecosystem, and inside as well to a degree, I guess, but mostly outside, there's a lot of effort right now and activity in other partner types that I work with around GDPR. That's clearly based on reducing risk, right? Because the cost of the fines are huge. And so it's a big risk that the business simply can't afford to bear. Bottom line, if you can reduce risk for a customer, you have a very strong sales argument, and you have very solid IP that chances are customers are not only going to buy, but are going to pay well for, because you can quantify the impact that it has. Reducing costs, obviously, another significant business lever, and increasing revenue, also another significant business lever. But if you look at your IP overall in terms of, having a focus, who's it for, and solving a business problem, what does it do? What specific business outcomes does it provide? Does it reduce risk? Does it reduce cost? Does it increase revenue? You have the starting point of a pretty solid set of IP. And the last part of it is more in terms of, so that those two things sort of identify what the IP is. The last point really deals with how to most cost effectively develop it. We've already talked about, solving a real problem, but what I really find is that the fast track, and this is quite key, the fast track to cost-effective IP development really lies in making sure that you have an anchor customer or two that you're working on developing that IP with. I have conversations with partners on occasion where they have this great IP idea, and they've put effort into building it. They've made investments in it. They've sunk cost into it. And when I ask the question, so who's have you worked with it? Like, who's your anchor customer? Have you worked with an actual customer to make sure that your IP is doing something that a real customer, is actually willing to pay for? There's an awkward silence because they haven't done that, and you really want to avoid that trap. You really do, I find, need to work with an anchor customer or two in a practical sense to develop your IP, to make sure that you're solving a real business problem, because if you can't convince them that you're solving a worthwhile problem, well, then you probably can't convince others like them that you are as well. And, it keeps the focus on the IP development, on the business issues and the business outcomes that are being delivered, rather than on the technology. Unfortunately, well, fortunately in some senses, unfortunately in others, we love technology. This is our business. And so, we sometimes have an urge towards developing solutions that are technologically, that have, cool technology, or that, that are cool from our perspective in the technology business, but that the business customer doesn't necessarily, find value in. The second thing that working with an anchor customer does, of course, is share development costs. I mean, this is the whole notion of customer-funded R&D, and very often this is, this is a significant part of the equation, because you can get the customer to pay for some of the development, right? You can use the project the projects that you're executing with anchor customers to fund some of your development costs. The third thing that working with an anchor customer does is it really credentials your solution, because if you want to sell the same IP-based solution to a customer in that industry, or another customer of a similar kind, that next customer is going to want to know that the product, that your IP is in use somewhere and is doing something meaningful, is having a meaningful business impact. And so working with an anchor customer credentials your solution as well, and gives you really early sales momentum, and the ability to more rapidly acquire more customers once you've got the basic kind of offering in place. And the last part is really perhaps one of the most important of all, and that's to not to do it over time. In this day and age, you really do want to not over-engineer or not make your own IP too complicated. That escalates the costs involved with it. It escalates or increases the time it takes you to develop it and get it to market. Really, the idea fundamentally is to leverage, the projects that you're doing with anchor customers to build over time a library of reusable code, so that every new customer that you that you work with in terms of your IP adds to your IP library, if you will, and that over time just gives you more and more IP that you can directly monetize. You don't want to start with trying to build, a big solution, because that simply, in most cases, takes too long and costs too much. So those are really fundamentally the keys to, boil down into a single slide, the key to cost-effective IP development, if you will, the fast track to cost-effective and rapid IP development. Now, I want to just sort of end with a little commentary on where partners are finding the funding for these things, for transitioning their business model to the cloud, for building out IP, and then we have time for questions after that. But typically, here's the progression of how partners are funding their cloud business model transition, if you will, and including their own IP development. The first is obviously out of operating profits. And depending on what market you are in, some partners have a greater level of operating profits than others. But clearly, that's the first source of funding for cloud transition is operating profits. Now, sometimes that won't be sufficient, and sometimes, depending upon how aggressive you want to be in terms of building out cloud-related offerings and getting them to market. And I would say, by the way, that the window of opportunity for establishing a market position as a cloud, as a cloud player with your own IP, or just a cloud player in general, the window of opportunity is still very much there. But it's not going to last forever either. And there is definitely a first mover advantage, involved here. In other words, the whole nature of the subscription, mechanism is that, once a customer starts subscribing to your offering, ideally including your own IP, unless you do something to lose the business, the chances are that they will continue to do that. They will continue to pay that subscription. That's just human nature. It's the way we are. It's your business to lose rather than continuously re-win, as you had to in the traditional business model, where every new implementation was basically you had to re-win the business. And what that means is that it's more expensive for somebody to take a customer away from you than it is for the first one in to get that customer to begin with. So time is a little bit of the essence here, and I especially now, I think it's important to be fairly aggressive if you are going towards a more cloud-oriented business model, to really move in that direction as you possibly can, and the most typical sources of funding for that are, first of all, operating profits and cash reserves. But in some cases, that's just not enough, and you want to establish a market position faster than that. And typically, this is where owners inject more money into, more capital into the business. Personal networks are leveraged to fund the investments that are needed. And then finally, once you have, I would say, an offering that is IP related, you start to be able to tap into other sources of funding to really accelerate, fundamentally at that point, the rate of customer acquisition. Also, to some degree, product development. But you really do want to have an established sort of product that works in the cloud world, and that has some customers to it, and that has some traction in the market before you start to be able to tap into sources of funding like private equity or look at mergers and acquisitions. So that is my presentation. These are my coordinates. Again, if you want a copy of the study or to contact me, that's where you go. And let me just take questions. So yeah.
Thanks, Dana. Can you hear me?
Any questions? I can, yes. Any questions?
This is Anna. Want to leave some time open for questions for the others as well. But just on top of my head, I had a question around the model that, basically I see two different models. If you want to cloudify your business, you can either try and change your whole operations around at once, changing everything that you do, both in terms of resources and the way that you transact and operate, of course. But then you can also try the route that I also see some companies do, that they simply establish a separate entity and do the cloud business via that. So they run their perpetual, their traditional business onwards, but do this as a separate entity where they're kind of really separated from the normal business that they do. You probably have seen lots of different models out there. What your experience is, some working better than others? What is your tips and tricks on that?
Yeah, that's a great question. So first of all, I want to be clear. It is important to keep the traditional business, moving along, because often that is the source of funding for building the cloud business. So you don't want to do anything to kill the cash cow, if you will. That said, the investments probably should not go into that traditional business and should be funneled more into cloudifying, exactly as you say, the business model. I would say that probably the most common, and in my experience, the most effective. I have seen partners literally set up entirely different businesses and and go at it that way. The challenge there often is that you don't get to leverage as much of the existing business. So, there will be resources, for example, that you can shift from traditional. Not every consultant can make this shift, by the way. So don't get me wrong, but there are resources that you can leverage in your existing business towards building the cloud practice, towards building out your own IP. And while you want to have that as a separate sort of part of the business, it doesn't necessarily have to be a separate entity, because if it's a separate entity, there are obviously costs involved with that. I mean, you do have to divide up, the different business models, if you will, but you don't necessarily, at least in my experience, have to make them totally separate entities. I'm not saying that that's wrong. Some partners do that, and it's very effective. But often, the more cost-efficient way is to leverage your existing business by having, for sake of argument, a separate, part of the business, a separate division within the existing business, than a whole new entity altogether.
Okay. Great, thanks.
Yeah, good question. Good question. Other questions? Has to be.
Don't be shy.
Yeah, don't be shy. If you had questions on the IM window, please just shout them out to me. I can't read that.
No, there wasn't any, Dana.
Okay, there you go. Anybody with any other questions?
We will be sending out the recording, a link to the recording, and the slide deck as well.
Okay, great. I will send you. I'll send you the PDF version of the slide presentation.
Good.
And you can, my coordinates are there if anyone wants to download the study or any of the other materials on my website. You know where to find it.
Thank you, Dana. Then we will close this session. Everybody, thank you for joining this session. You will receive the recording and slides afterwards. And thank you for joining, and have a great evening.
Thank you, Dana.
Thank you. Thank you.